Valued investors, summer is right around the corner. I hope everyone has their rest and recovery time scheduled because 2025 has certainly kept us on the edge of our seats thus far. The latest recovery is another reminder that periods of turmoil can often create opportunities. Although stocks may pull back after their strong rally since the April 8th lows, especially if trade deals and tariff reductions don't materialize soon, the lesson is clear. In our view, staying the course during downturns is almost always the best strategy. There are several factors at play in the market's recent recovery. Number one, optimism about trade and tariffs. The White House has signaled progress on deals with several countries, including India, South Korea, Japan, the UK, and even China most recently. President Trump has also reduced many tariffs across the globe, including China. Treasury Secretary Scott Bessent has already met with and begun back and forth negotiations with senior Chinese trade officials. As of earlier this month, the United States and China have entered a temporary trade truce, marking a significant de-escalation in their ongoing trade tensions. Number two, the resilient economic fundamentals. The U.S. economy added 177,000 new jobs in April, keeping unemployment low at 4.2%. Consumer spending grew at 1.8% in inflation-adjusted first quarter, while business investments surged over 20% annually. These are the bright spots that were overshadowed by concerns about the 0.3% dip in gross domestic product, GDP, which was caused by surging pre-tariff imports. A rebound in second quarter GDP should prevent consecutive quarters of contraction. The third reason for recent strength was easing inflation, which was delayed but is still coming. While tariffs may slow further improvement, we and the markets expect inflation to resume its downward trend toward the Federal Reserve's 2% target by 2026. Falling oil prices and declining long-term Treasury yields should continue to add tailwinds to lower inflation over the long term. Yields in 2025 have been volatile due to fiscal policy concerns, the recent credit rating downgrade by Moody's, as well as the shifts seen recently in the dynamic global markets. The fourth catalyst is the strong corporate profits. S&P 500 firms delivered 13% first quarter earnings growth, roughly double expectations when earnings season began. Leading technology companies have reaffirmed or increased capital spending plans despite trade uncertainty, committing to more than 30% increase in 2025 over 2024, underpinned by confidence in the potential payoffs of artificial intelligence. Looking ahead, stocks may need a bit of a breather after making up so much ground so quickly. Stagflation risks cannot be dismissed as growth slows and tariffs loom. While the U.S. economy and corporate America remain in excellent shape, we suggest investors maintain exposure to equities and fixed income in line with long-term targets. Better entry points to add to equities may present themselves with trade uncertainty still very high, ongoing economic uncertainties, and inflation concerns continue to influence corporate outlooks and investor sentiment. Despite periodic short-term disruptions, markets are inherently resilient. History shows they may recover regardless of the threat. Stocks tend to reward disciplined, long-term investors. Few exemplify this discipline better than Warren Buffett, who announced he will step down as CEO of Berkshire Hathaway after 60 years in that seat and will remain chairman. His track record, 16% annualized returns since November 1987, compared to 10.9% for the S&P 500. this will be tough to beat. We wish him well in his retirement at the age of 94. Thank you for your continued trust, and always stay safe and stay the course.